Welcome everybody to another episode of Real Estate Exam Prep, where I break down the material that's on the real estate salesperson and broker's exam so you can pass on the first try. So today's lesson is going to be on capital gains. Okay, so we're going to talk about capital gains and we're going to talk about 1031 exchanges and what you need to know and break it down so it's super easy. So the first thing is, what is capital gains? Now, when we're speaking of capital gains, really what we're talking about is you're selling a property, whether it's an investment property or it could be your personal property, and we'll get into that too. You're selling a property and you're gonna have to pay some taxes, right? Well, how much do you pay in taxes? It all depends on what your capital gains are, right? So how do we calculate the capital gain? So really, by definition, capital gains is gonna be the difference between the net selling price of a property, right? Net selling price, not gross. So your sales price minus, expenses and things like that. I'll show you an example. Your net selling price minus your adjusted basis. And I'll go over how to calculate or come up with what your adjusted basis. It sounds more complicated than what it is, okay? Whatever that difference is, whatever that number is, you're gonna pay taxes on that number. That number does not reflect your tax payment, but just you're gonna pay a portion of taxes from that number. And I'm gonna show you some examples, okay? So let's get through all the basics up first. We'll go through an example and then it'll all make sense. So that was capital gains. Now, what's the net selling price? Well, kind of went over it a little bit, right? So when you're selling a property, what you wanna do is figure out what the sale price was, but then you're gonna minus any expenses that occurred while you were selling the property, right? So think about maybe the commission for a realtor, 5-6%, whatever that is can get deducted. Your closing costs are going to get deducted from your sales price, and that's going to reduce what you made on the property, right? What you gained on the property. So first we come up with the net selling price. Then the basis. So what's the basis? Basis is really your starting point. Basis is, what did you buy the property for? That's it. So the original investor, what did you buy the property for? That's your starting point, okay? So what we're doing is, what capital gains is, we're figuring out you bought the property at this price a long time ago. You sold the property at this price today, okay? There's a difference. You made some money. From this portion here, Uncle Sam wants their cut, right? And that's where we start. That's going to be your capital gain liability. That's your capital gains. Now, what's adjusted basis? So, adjusted basis, and the cool thing about capital gains and all that stuff is that from your basis, from your selling point, right, where you first bought the property, right, your starting point, they will allow you to add expenses. So if you made any physical improvements to the property, right? So let's say you're getting a house ready, you're gonna vinyl side the property so that we can get more money out of it, but the vinyl siding costs you $14,000. Cool, right? So you have $14,000, and let's say you bought the property for $100,000. Well, guess what? You can add now that $14,000 to your $100,000 basis. So now it looks like you bought the property for $114,000. And that's good. You want your basis to kind of go up, because if your basis goes higher, then what you're going to owe in taxes, or what you're going to show what you gained, is less. So the lower that cushion is, that number in between the net selling price and your adjusted basis, the better it is for you as far as what you're going to pay taxes on, okay? Now, and we'll get into some rules. So adjusted basis, the way it works is that from your basis, you can either add any physical improvements or any other expenses that incurred while you were selling the property, right? That were necessary in order to get the property ready so you can sell it. Now, if you're an investor, chances are your accountant has told you, listen, you should claim depreciation of your property, right? And what's depreciation? Loss of value. So, what they're saying is that, listen, you have this property, over time, there's wear and tear, you have to maintain, blah, blah, blah. So on your taxes, you're able to deduct depreciation and you get some money back. The problem is when you go to sell it, the government says, all right, well, we gave you money, you claimed depreciation, we want that back. So what happens with your adjusted basis is, in addition to whatever physical improvements you made on the property, you now have to subtract anything that you depreciated on the property, right? So let's just say, make numbers easy, that we did the vinyl siding for $14,000, right? And let's say over the years, you depreciated about $10,000 worth of value. So if you take $14,000, subtract $10,000, that's only $4,000. So your basis now gets adjusted. So it's instead of the $100,000 purchase price, and instead of being at $114 with the siding, you add the $114, subtract the $10,000 for depreciation because you already got that money throughout the years. Then really your adjusted basis is going to be $104, so $104,000. Okay, and we'll do a math problem. So real quickly, right? Capital gains is going to be what you made on the property, right? It's going to whatever you made, the amount you made on the property. The government's going to be looking to tax that number, so that way they get their taxes out of it. Okay, your basis is going to be your starting point. That's going to be what you paid for the property in the very beginning, however long ago. That's what you paid for the property. And your adjusted basis is going to be, well, if there were expenses that took place to sell the property, you can add that to your basis, so it reduces your tax liability. But if you've claimed depreciation throughout the years, you're going to have to subtract the depreciation. Okay, and we'll get into an example. So in this example, we have an investor that sold the property for $400,000. Now, again, remember, we have to calculate in order to come up with our capital gains, we need to know what our net sale price was, right, or is, and then subtract that from the adjusted basis. So let's start with the net sale price. So they sold the property for $400,000. Let's say commission was 5%, ends up being $20,000. So that's what they paid in commission. And let's say the closing costs for the property were $3,000. So at that point, the total expenses to close, right, on the property was $23,000. So we're going to take the $400,000, subtract that by $23,000, and that's going to give us $377,000. That's our net sale price. Okay, so that's our starting point. Now we need to figure out, well, how much did the investor buy the property for? What was the basis? Well, here in the example the basis is $175. So the investor bought this property for $175,000. That's the basis. Okay. However, in selling the property, the investor paid an extra $14,000 to side the property to get more money out of it. Okay, so we're going to now add that $14,000 to the basis, and that's going to bring us now to $189,000. So that's our new starting point. But wait a minute, the investor also claimed depreciation throughout the years. So in this case, the investors claimed about $25,000 in depreciation. So we have 189, we now have to subtract the depreciation. So we subtracted 25,000, and that gives us an adjusted basis of 164,000. So in this case, it kind of works against the seller, right? Because of the investor, because of so much depreciation that they, that they had to pretty much recapture. So it's 164, where originally was 175 was the basis. So this person's gonna have to pay more in capital gains. So now that we have our adjusted basis, and now that we know our net sale price, we subtract it. So 377,000 subtracted by 164,000, that's going to give us $213,000. So this is what the investor walks away with, right? This is how much they made on the sale of the property. But from the 213, now they're going to pay taxes on that, right? And what they're going to pay on taxes is going to be determined by their tax bracket and all this other stuff. So it could be anywhere from, like 20% or as high as 37%, depending on, if it's short-term capital gains and all that other stuff. And I'll get into that in just a second. Okay, so I hope that kind of helps break down how you come up with, how you derive capital gains, what that is. And then remember, that capital gain, that number, that is not what you're going to pay in taxes. It's just that's the taxable amount. That's what the government can tax you on, is that figure there. So definitely when you're selling a property, talk to your accountant, because they will help you get creative and figure out what's the best way to adjust your basis the right way, so that way, you can keep more money in your pocket. Now, for these capital gains. Are there exemptions? They are, all right? There are exemptions to capital gain rules. Now, in Massachusetts, these exemptions are only for single family homes, okay? So if you have a multifamily, it doesn't apply. It's a little bit tricky with multiple, I'll get into that in a second, but primarily this is gonna be for single family homes. Now, here's how the exemption works. If you are a single individual, right, you're not married, and you own a property, you get a $250,000 exemption, meaning if you sell the property, as long as you do not make more than $250,000, you walk away. As long as you don't walk away with more than $250,000 on the sale, you don't pay any capital gains tax on it. It's your money. It's good. Okay. If you're married, that exemption doubles, and now it's $500,000. So if you sell a single family, as long as you don't make more than $500,000, you now get to keep that money. You're not going to pay taxes on that. Now, there's rules with the exemption. The property has to be your primary residence for 2 out of the past 5 years. Okay. Now, it doesn't have to be consecutive. So for instance, let's say you lived in the property for a year and you rented it for 3 years, and then you moved back in for a year, right? And then you decided to sell it. Well, you have 2 years, 2 out of the past 5 years. You lived there as your primary residence, and yeah, so you made money on the other years, but that's okay. You still get that exemption, okay? Now, what happens if you sell the property and you make more than what the exemption allows? Well, what happens there is that you'll still get your exemption, but whatever that difference was, that's what you're gonna pay taxes on, right? So let's say you're single and you sell the house and you make $300,000 on the property. Well, your exemption is only $250,000. So you'll still get that exemption, $250,000 gets wiped away, but you have $50,000 now that you're going to pay taxes on. Again, you're not paying the $50,000 completely to the government. They're just going to tax you on that $50,000. And depending on your tax bracket will determine, what the percentage is that you're going to be taxed on that. Now, let's get into this tool, this technique. I love this ability that we have here, okay? So under the tax code, there is something called a 1031 exchange, okay? And investors have been using this for a very, very long time. However, a lot of common folk are not, familiar with this system, and they can save a lot of money. And this is how a lot of wealthy people still continue to, retain their wealth by selling properties and not having to pay the taxes back. It doesn't go away, you defer it, but let me show you, okay? So what 1031 exchange will allow you to do is whatever you are going to pay in taxes, right? If you're gonna pay, whatever the liability was, let's say you sold the property and you had to pay $50,000 in taxes, they will allow you, the government will allow you to take that $50,000, reinvest it in another property. Now you still owe it, it's just deferred. It's deferred until you sell that other property that you're going to buy. So until you sell that property, you can take that $50,000, use it to reinvest in another property, and there's your investment, right? You can make money off that property for years to come. And then when you decide to sell that property, that's when you pay the $50,000 that you owe the government. However, you can continue doing 1031 exchanges and pretty much roll that money over and over and over forever, okay? So this is a phenomenal tool. However, there are rules behind it, okay? So let's get into what those rules are. So there's 7 rules that you have to abide by in order to do a 1031 exchange correctly, okay? So the first one is like-kind property. Now what that means is that whatever you buy has to be an investment property, right? Now it doesn't have to be identical. So for instance, if you're in Massachusetts and you sell a 3-family, you don't have to buy another 3-family in another state or whatever it is. It could be within the state or it could be another state. You're not limited to just the state that you sell the property in. So whatever you buy has to be like kind. Now, you don't have to buy just one property. You do have the ability of buying multiple properties as long as it follows the rules, being like kind, and the dollar amount has to be a certain amount, and we'll get into that in a second. Rule number 2, again, it has to be investment purposes or for business purposes. It cannot be for personal use. Rule number 3, the property that you purchase or properties have to be for equal or greater value. So let's say you sell a 3-decker here in Massachusetts at $400,000. Whatever you buy, the minimum has to be $400,000. Now, let's say you find 4 condos in Florida at $100,000 a piece. Well, you add them up, there's your $400,000. So you could do your 1031 exchange and buy those properties, because those will be lifetime properties. You're going to be using those as investments, right? You're going to be renting those out. So it'll be lifetime. So as long as it's equal or greater value, then that's fine. You can do that. It just can't be less than what you sold your original property for. Next one is you must not receive boot. Now, what is boot, right? So really boot, what they're referring to is that when you did your deal, right, that you were clear as far as what your exchange is about, and that the property that you're buying, they're not giving you some extras that you're not claiming, okay? Government doesn't want that. They want full transparency. What are you getting? What are you getting for value? Because if that property, really, if you bought it for more money, more than the equal, more than greater value in which you sold your property for, well, they want to know, because now when you if you do the 1031 exchange again, guess what? Now that threshold is higher, right? So they just want to make sure that everything that you do, you have to be completely transparent, that you're not receiving any extra from the deal that you're not claiming on the 1031 exchange. All right, rule number 5. Rule number 5 is going to be the same taxpayer. So you, right, if you're the one selling the property, you're the one buying the property. So you need to make sure that you're able to afford the properties that you're buying, even when you're selling the property. So this is where you want to make sure you're talking with your lender, you're talking with your accountant to make sure that financially you're going to be able to meet that equal or greater value on the sale, right, of whatever you're going to purchase for the lifetime property. Now, here are the real big rules, okay? So rule number 6 is that you have a 45-day window to identify which property or which properties that you're going to be purchasing. Okay, so when you close on your property, your investment property, on that day, there's a clock that starts ticking, 45 days. Okay, and within 45 days, you have to identify, not close, identify, say, yep, these are the properties or property that I'm going to be purchasing. And then the last rule, rule number 7, is that you have 180 days to close on that property. Now, if you don't do that, if you don't identify the property within 45 days, or if you don't close on a property within 180 days, guess what? No 1031 exchange. Whatever you would have to pay in taxes, whatever that liability was, you're going to have to pay it, and that's it, and it goes away. Okay, so there you have it. 1031 exchange is a tool. It's a tax code. You have your 7 rules there. We went over capital gains, basis, and adjusted basis. Okay, so I hope this was helpful. If you have any questions or you want me to break anything else down, please leave a comment below. Let me know. If not, well, thank you, and I'll see you in the next class.